Hi everyone, I'm Kyle Bechet, and this is the AAF Exchange, a podcast from the American Action Forum, where experts provide clear, data-driven insights into today's economic and domestic policy issues. Welcome, and thank you for tuning in. On this episode of the AAF Exchange, the Silicon Valley Bank, the collapse, the reaction, and what happens next. Joining us to discuss all of this, as usual, AAF's President, Douglas Holtz-Eakin, and for this episode, AAF's Director of Financial Services Policy, Thomas Wade. Thank you both for joining us.
Thank you.
Good afternoon.
So let's jump right into things today, because we obviously have a lot to talk about with everything that's happened the last week or so. Last week, we saw the collapse of the Silicon Valley Bank. Break down for us what happened and why it happened.
Go, Tom.
Sure. So Silicon Valley Bank, a bank set up in 1983 to lend specifically to the crypto and startup communities, has overwhelming concentration in that sector. Something like 60% of the portfolio held by SVB at the time in which it collapsed was held by specifically private equity and venture capital. So highly, highly concentrated in one specific sector. Over the course of the pandemic itself, management bid very, very heavily on long-term treasuries as an asset class. Now, long-term treasuries, despite being obviously a government-backed asset, and so therefore extraordinarily low risk, simultaneously both zero risk and very, very highly exposed to interest rate risk, which is part of what puts us in such an odd position. This obviously was the position during the pandemic when we were in the era of free money, when the cost of borrowing was low to essentially nil. Obviously, as the Federal Reserve has raised rates over the last, how long has it been, Doug?
Started in March of 2022.
So yes, coming up on a year now. We've seen rates increase. We've seen the cost of borrowing increase. And this has had impacts on a number of sectors, most obviously on the tech sector. So you will have seen across everything from the big FANG companies all the way down to tiny startups, we're seeing a real pressure start to build, and the cost of capital and borrowing has obviously risen. So SVB's clients started to feel this pinch and either started to withdraw their money from SVB or just stopped depositing at the same rate. Either way, SVB faced a very, very short-term, possibly quite minor liquidity crisis, and they needed to realize capital quite fast in order to meet that need. However, given how hard they had invested in long-term treasuries, which are ideally supposed to be held to maturity over 10 years or whatever the term is, they didn't have very good options for realizing those short-term cash needs. So what they did was they attempted to sell these treasuries at, given the rise in interest rates, significantly below their market value. This was considered a poor enough choice by venture capitalists, including Peter Thiel, that they saw this and raised the alarm, essentially. So what we then had a run on the bank. So far, so relatively normal. What made this so astonishing was the scale, but also, almost more importantly, the speed. So Doug and I are very fond of the statistics here that depositors at SVB attempted to withdraw $42 billion worth of cash in only 10 hours. So this was money going out at about $1 million a minute. Obviously, the bank couldn't withstand that staggering loss of investor confidence. The bank went into receivership on Friday, and over the weekend, the FDIC attempted to find a buyer. Now, what is truly unique and fascinating about this is the two administration government reactions to this. Doug, do you want to cover those?
Well, I think the other thing we need to point out is that this is a bank no one ever heard of, but it was the 16th largest bank in the United States. It had quietly gotten very large, and it had gotten very large recently. It doubled in its assets in the past year, I think, maybe a little bit longer. And as Thomas is fond of pointing out, banks that grow that quickly in a short time typically don't have their internal controls and their risk management grow at the same rate. And that's kind of a classic recipe for getting in trouble, and SVB did. The other fun fact, because I'm sure the purpose of this is to prepare people for cocktail parties, is that the previous biggest bank run was about 17 and a half, almost $18 billion. And that took place over 10 days. So this is astonishing in its scale and the speed. And it really did whipsaw the Silicon Valley area. There's no question. The rumors started flying. There's a great story in the Wall Street Journal about all of these venture capitalists being on a bus together, going to some retreat in Montana and realizing that everybody was on their cell phone and everybody was trying to get their money out. They were the bank run and they were on the bus doing it. So
I think that was the South by Southwest conference that they all got.
I think
that's what happened. Just say 2 words, Tom, about Signature Bank and Silvergate. There were 3. Everyone talks about Silicon Valley Bank, but there were 3, and the other 2 weren't as interesting.
Yes, well, rather, it's a very similar story for both of them. I think the reason why SVB, Silicon Valley Bank, has taken up so much ink is simply because of the scale. As Doug says, it's the 16th largest bank in the US, and neither Signature nor Silvergate, getting all these S's mixed up, present anything like the same scale. However, what all 3 banks have in common are essentially 3 things. One, extraordinarily narrow customer base, a lot of it in tech. What we're seeing is actually conversations now about crypto, because I can't escape conversations about crypto all the time. And certainly Silvergate and Signature both have significant exposures to the digital assets market. And I think this doesn't say anything too interesting about crypto in this instance, except that the industry is extremely exposed to macroeconomic factors. The second thing that these banks will have in common is that, and this is sort of fairly unique, is that they have very, very low amounts of their deposits were insured by the FDIC. So the way this works is that any deposit for a major bank of less than $250,000, it has an FDIC guarantee. So to an extent, it is backed by the full force of the federal government. And that the conventional wisdom is that banks who have FDIC guarantees on a lot of their deposits, and the average for most large banks is about 50% of their deposits will be FDIC guaranteed, are more or less immune to a bank run, because you know that at the end of the day, someone will be footing the bill. Again, in the realm of staggering statistics, somewhere between 94 to 96% of Silicon Valley Bank's deposits, and the same also goes for Signature, were not guaranteed by the FDIC, because all of these accounts were over $250,000. So this says profoundly interesting things. But I think one other small flavor to put on this is tell me if you think this is unkind, it's difficult to root for the little guy in this case if 96% of the depositors were holding more than $250,000.
Yeah, Thomas, you made an interesting point that I've heard a lot of, Doug talk about on, all the shows he's been on this week, that a lot of these people weren't used to dealing with the 0%, were only used to dealing with these 0% interest rates, which I think is a big part of all of this in the banking industry itself. Do you see that as a larger problem, or just in this instance?
Absolutely. And I think there are 2 really interesting themes to mention here that we'll probably tease out over the rest of this interview. One of which is that at the end of the day, Doug and I see what happened to SVB as being a classic case of management failure. They had what we view as being a terrible asset mix, in that they had bet so hard on these long-term securities and had no way of realizing short-term funding in a way that wouldn't spook their investors. But this is symptomatic of a broader problem, which is that as the Federal Reserve continues to raise rates, we will see other major banks in similar issues, or rather the value of long-term treasuries has gone down across all banks that hold them. And so there are interesting conversations to be had there about systemic risk insofar as it exists. But the short, snappy answer there is that all 3 banks that went under this week had terrible asset mixes, terrible investment decisions made by their management, and, as mentioned, had deposits that weren't backed by the FDIC.
Many are also, drawing a comparison with the SVB collapse and the 2008 crisis. Doug, you were a part of the commission around that. What do you make of all this?
I think that's really misplaced. If you go back to 2007, 2008, there was global in nature. Some of the initial failures that became important in the U.S. were overseas in France, and a lot of the assets were not held on the balance sheet. They were held in these special purpose vehicles, and you couldn't really see them unless you were a sophisticated participant. Even when they were on the balance sheet, they were often these very complicated derivatives built off of underlying mortgage risk, but you couldn't figure out how much of the risk was actually on the balance sheet because of the derivatives. It was all highly leveraged, and leverage is a risk in and of itself. If you're playing with other people's money, you're at greater risk always. And so the sort of difficulty in figuring out who was at risk in 2007, 2008 was really a major challenge, right? Is this bank fine or is it not fine? I don't know. What's so fascinating about Silicon Valley Bank is, these venture fund guys are very sophisticated, and they looked at the bank and said, "Oh, we can see that this bank is not okay. Give us our money to now," and so it's completely different than what we saw back then.
And sorry, even if we were hypothetically to face a similar set of situations or set of circumstances, the fact is that today's banks are so much better capitalized than they were in 2000, 2008. So it's not the same circumstances, and even if it were, banks are better positioned to be able to deal with it.
What about this? On the other hand, some in Congress are pointing to that 2018 banking reform as one of the reasons SVB collapsed. What do you make of that argument?
I don't buy this at all. So the quote regulatory failure that we can see at the moment, if there was one, is the fact that there was this terrible mismatch between what they were holding in the way of these long-term treasuries and their need to raise money quickly and get it to depositors. That is something the supervision process should have uncovered, right? And it would have uncovered it under the 2017 rules. It would have uncovered it under the 2019 rules. This doesn't appear to be a problem with rules. This is a problem in executing on those rules. And it's a mystery to me how it wasn't discovered. It really is. The Fed has set up a task force to go investigate the supervision process. That's appropriate because this is a bit mysterious, and they have egg on their face, right? This is the San Francisco Fed had the primary supervision of Silicon Valley Bank, and so they need to find out what went wrong there.
Yeah. So before we move on to the collapse, the response to the collapse of SVB, I wanted to ask about the events that have unfolded today with another bank seemingly going down. Do you have any thoughts about that? Has that changed sort of the outlook of what's happening with all of this, or does it not really change much?
So my take on this is pretty simple. The bank in play today is Credit Suisse, and Credit Suisse has been a financial nightmare for a while. It's not well capitalized in general. It has had all sorts of trouble with internal controls and risk management systems, well documented. It's been fined numerous times for not meeting standards. And so no one should get out of bed and be surprised that Credit Suisse has some problems. What happened today was its Saudi Arabian backer, when asked for more money, said no. So that sets off the sort of the death watch that maybe they're not going to make it. Later this afternoon, they then turned around and they asked the Swiss central bank to vouch for them, and there's a really resounding silence at the moment on that front. So what you get is this sort of every time there's this rush in the market for guilt by association. So take a bank that's roughly Credit Suisse's size, that has roughly its kind of loan mix, and say, okay, we need to worry about them too. And then by tomorrow, once they've looked at the books and they've thought it through, a lot of investors are going to be like, wait a minute, those banks aren't the same. These are not close associates, and we'll see some recovery, I think, in the other bank stocks.
Interesting. Okay, let's talk about the response to the SVB's collapse, because I know you both have some thoughts on this matter. Some are using the word bailout. Some are avoiding the word bailout like the plague. What say you both? Go ahead, Tom. You can start on this one.
So there's no way this is not a bailout. So there are a couple of there are two different responses that the federal government has taken. One has been to turn around and guarantee the deposits of everyone and everything at SVB, with some in Congress arguing that they should go even further and temporarily guarantee the deposits of every deposit in the United States, which is just baffling. And this is just the most odd case of moral hazard. It completely undermines the entire purpose of the FDIC guarantee program for deposits under $250,000 if every deposit is going to be guaranteed. And I think there are definitely questions that we need to ask, because it seems to have been, in theory, in reaction to potential systemic dangers or risks, or the idea that this could in any way destabilize the banking system, which feels feels risk averse, if nothing else. But this is a relatively, and not to downplay it, this is a desperately troubling precedent set for every other deposit in every other bank failure in the future. But it actually pales in comparison to the other half of the federal response, which is the creation of a new emergency bank funding program, which essentially will allow banks to take loans from the federal government for any amount on very, very generous terms, insofar as it will allow you to put up, in exchange for the loan, assets that the government will happily take off your hands valued at par rather than at market value. So any similar firm in SVB's case, if there are any left, could at this point give the federal government their long-term treasuries, get paid what they, this hypothetical price that they would have been worth, 3 years ago, and receive loans in response to these essentially dodgy assets. And that is desperately worrying, because the incentive there is for banks to never manage risk ever again, because why need they? Any management failure, any risk management failure, any capital failure ceases to matter if the federal government will just step in and rescue them at the last minute. It's no longer too big to fail. It's now become just too bank to fail.
and the flips, and remember, that's absolutely true. And meanwhile, the depositors are guaranteed their money, so they're not paying any attention. Like the bank announces, we've decided to put everything into bets on WWE wrestling matches. They'd be like, okay, good, I'm getting my money back, right? I mean,
and speaking of the
that's a terrible thing. There's an old saying that uninsured deposits are called market discipline, and there is none here, and that's the problem.
And speaking of the taxpayer, it's even worse than that, because behind both of these the two prongs of this government response, this administration has told us that the taxpayer won't be ultimately footing the bill in either case, which I don't understand logically how that could be the case, but putting aside where they think money comes from.
What does this have to do with logic?
The FDIC guarantees will come from an FDIC fund, which, at the end of the day will be footed by the taxpayer. But the bank lending facility is even more problematic than that, because that is being funded by a treasury vehicle known as the Exchange Stabilization Fund, which is a fund set up specifically to mitigate the risks afforded by exchange rate currency conversions. And Doug, you have to remind me exactly when they set the ESF up, but it's never been used as anything other than just the most horrific slush fund by Treasury. It is an emergency fund by any other name.
You can trace the ESF to John Maynard Keynes and the Bretton Woods agreements. We were all going to have fixed exchange rates and life was going to be grand. And when Nixon took the U.S. off the dollar in the early 70s, the Exchange Stabilization Fund lost its reason to be. But the Treasury did not lose the Exchange Stabilization Fund. They could use it for anything they wanted since.
Rainy day.
Yes.
Yeah, just to I mean, I know Thomas hasn't been on the podcast in a while, but usually we avoid conversations of logic.
If Doug's involved, I'm not surprised.
This is a policy discussion, okay?
Right. There's already been calls to say that, the lack of regulation, the lack of oversight is the reasons for that. We talked about that earlier in the podcast. What are the chances that, Congress or Washington, policymakers try and pile on more regulations to this just to look like Washington is doing something?
High in the sense of we're going to see a degree of messaging involved, and we've already seen a degree of messaging involved with this. There are two halves to this story. One is are banks capitalized at the correct level? And the other is the assault, quote unquote, on Dodd-Frank. Taking Dodd-Frank first, a lot of the conversation, as we've already discussed, is around the 2018 Trump tailoring of Dodd-Frank requirements for mid-sized banks. But it's interesting that, better scholars than I, including people like Dan Tarullo, have said that in neither case, if Dodd-Frank was exactly the same and if banks were capitalized, exactly as required, in both cases, SVB would have failed, because just as a reminder, this is 25% of their balance sheet going out the door in 10 hours. No bank is built to withstand that, and no bank could be built to withstand that and operate on anything like a profit. So we're going to see conversations about this tailoring for mid-sized banks, which is honestly, I wonder whether the people calling for it have read it, because it's extremely boring, trying to cut back on mid-sized bank reporting requirements and getting rid of some of the capital ratios. The other half of it is just more generally this idea of capital requirements at large. And as I mentioned, banks in the US, and particularly the largest banks, are astonishingly well capitalized at the moment. They're all sort of hovering at around about the 14% mark and are more resilient than ever, something that everyone in the administration is actually recognizing. However, in the background of this conversation, and this might be wandering away from the point slightly for a moment, is we've started to see rumors from this administration about attempting to raise capital requirements, particularly on the largest banks. So Michael Barr, the vice chair for supervision, raised this idea of a holistic capital review a couple of months ago. And so the collapse of SVB comes at the worst possible timing for this conversation, because banks, particularly the largest banks, were starting to worry about what was coming down the pipeline. And this will add a lot of gas to this particular fire, despite the fact that it fundamentally wasn't a capital problem.
And I think we won't see legislation get through, Kyle, but we will see things like the Federal Reserve having a tougher stress test. We're going to move interest rates a lot and see how well you would survive as a bank. And then they'll point to that and say, see, we have responded to the SVB debacle by making the regulatory environment much tougher. And that's inevitable. They cannot be seen as doing nothing.
Yeah, I want to get back to the Federal Reserve, but I also do want to quickly zoom out a little bit here. We saw, Moody's update its view of the banking system to negative earlier this week. How will markets and other regional banks respond to this?
So I just want, for the listeners, Moody's downgrading the sector, having a negative outlook, is not saying the sector is going to go bankrupt. It's not saying that in the sector we're going to have massive financial problems of an SVB type. Moody's is there to evaluate the profitability of the sector and the firms in it, and whether they are well situated to make money over the long term. This sector is less well situated to make money than it was 2 weeks ago. Inevitably, these firms are going to have to hold more capital as a precaution against their capital being less valuable than they thought, and the perception that it is less valuable than they thought. They're going to try to insulate themselves from that. Everybody is trying to make sure they don't look like SVB, and they don't SVB, and they don't want those problems. The other thing is, if you want to have more secure deposits, pay more interest on them. So the recipe to not having any suspicion about you is to run a less profitable business. Hold more capital, make fewer loans, pay higher costs, make less money. Yeah, that's a negative outlook. And if you're an investor, that's not where you want to send your money. Send it somewhere else.
So final question for you both. Some have argued that the bank's collapse will spur the Federal Reserve to pivot from rate hikes to pause or even rate cuts. Doug, Tom, based on everything Chair Powell has said, this prediction just seems, what's the best word for this, absurd. What do you both say?
Everything Jay Powell said. Going back how far, Kyle?
You're going to test me on the time limits on this, but all right.
No, look, my take on this is real simple. Remember what Tom said about this, the thing they don't want to talk about. They're talking about the guarantee. They've taken care of the little guys who are venture capitalists, and but they have this fund to take care of banks to get themselves in trouble. Well, that's the tool for bank stability and financial market stability. It's there. They have it. The tool they have for inflation is interest rates. And we got a CPI report yesterday morning that suggested inflation remains troublingly high, that core-like measures are not coming down as rapidly as they would have originally hoped. It seems to me that is not the moment when you make the biggest mistake the Volcker Fed made and pause prematurely. They have said repeatedly that was their mistake. They won't do that. So I see them raising another 25 basis points. Pausing sends the wrong message. I think this took a 50 basis point raise off the table because they don't want to look like they're trying to crater the banks. But I do think they have to keep marching because to fail to get inflation back to 2% in a timely fashion is to fail a big credibility test for the Fed, and they need their credibility fully reestablished. So I'd be surprised if anything other than that happens.
I think the only thing I would add to that, and I agree with Doug entirely, is I'm somewhat baffled by the idea that, yes, we know times are tough. Yes, we can anticipate that times are going to get tougher. Why would we assume that no bank would fail? The whole purpose of this exercise is to weed out the weak. And so
only in America's, in every other industry, firms fail all the time. But when a bank fails, we collectively lose our minds. It makes me crazy. Firms fail. Move on. The right firm failed. You take a look at SVB, they're a terrible bank. Make them go away. Keep the good banks. It doesn't make any sense.
Well, I hate to cut this off, but I'm sure Doug could go on forever about being angry about this topic. And I'm sure we'll see a few more dishes on this topic. But thank you both for joining and breaking down all these issues for us.
Well, thanks for having us.
Thanks, Kyle.
I hope you enjoyed this conversation. Tune back in for our next episode, where our experts will provide clear, data-driven insights into today's economic and domestic issues. I'd also encourage you to check out any of the links in our show notes and also follow us on social media to learn more about AAF. Don't forget to subscribe on iTunes, Spotify, or Google Play.